Avantor just delivered their Q2 2026 earnings, and the headline is a consolidated beat across the board.
Yeah, they really came in ahead of consensus on this one.
Right, so reporting total revenue of $1,692 million dollars and an adjusted EPS of 21 cents, which, easily cleared the GAAP diluted EPS of 6 cents.
And on the back of that outperformance, management actually raised their full-year guidance,
Exactly. They bumped their organic revenue growth range to between negative 0.5% and positive 0.5%.
which is a solid step up from their previous target of negative 2.5% to negative 0.5%.
Yeah, and they also lifted their adjusted EPS guidance to a window of 80 to 83 cents. Unsurprisingly, the stock caught a strong bid and reacted exceptionally well to the beat and raise.
It did. But, if you look closely at these numbers, this entire rally is built on a pretty fascinating paradox.
Oh, for sure. I mean, imagine replacing over 60% of your executive team in a single year, reporting negative core growth, and having Wall Street literally cheer. That is exactly what we are unpacking today for you. We want to see how Avantor achieved this beat and what the underlying segment data actually reveals about their turnaround trajectory.
Because it is a remarkable situation. I mean, when you strip away the headline shine, you are left with a company actively undergoing massive structural surgery
Yeah.
while, still trying to satisfy the quarterly demands of the public markets.
Right, and before we dissect the individual segments to see how they actually pulled off this beat, we have to talk about the primary metric driving that paradox.
The organic revenue number.
Exactly. Total reported revenue was technically up 0.5%, but their organic revenue actually declined by 0.4%.
Yeah.
For anyone tracking this, organic growth is the metric that strips out the noise, right? It removes foreign exchange rate fluctuations.
And the impact of recent acquisitions or divestitures.
Right, so it shows you the true unmanipulated sales volume of the core business. So their unmanipulated core business shrank by 0.4%.
Right, it's technically negative.
So how does a company declare a victory and a strong quarter when that core growth is still shrinking?
Well, it's because markets operate as forward-looking weighing machines.
Yeah.
I mean, they are rarely pricing in absolute static growth.
Right.
They're pricing in growth relative to expectations and, historical trends. Going into this quarter, the consensus was heavily weighted toward a much steeper contraction.
Because the entire life sciences sector has just been suffering through this brutal post-pandemic hangover.
Exactly. During the pandemic, labs and manufacturers hoarded supplies.
Yeah, understandable.
Which led to a massive inventory destocking phase that essentially paralyzed new orders for the last 2 years.
Wow.
So when Avantor reports a 0.4% decline against Wall Street expectations of, say, a 2% or 3% drop.
Oh, I see.
Yeah, that is the textbook definition of a better-than-feared scenario for retail investors.
Okay, so the market isn't rewarding the negative growth, it's rewarding the fact that the gap is shrinking.
Right. The bleeding is slowed dramatically. A 0.4% contraction signals to institutional capital that the bottom of the cycle is likely in.
And once the bottom is established, the market begins to price in the inevitable recovery.
Exactly, which is why the stock reacts positively despite the technically negative organic print.
Okay, so the narrative is that the worst is over. But we need to look at the segment performance to prove this wasn't just, some accounting magic or a lucky macro fluke.
We need to see the actual turnaround.
Right, evidence of a real operational shift. Let's start with their biggest engine, VWR Distribution and Services. This segment returned to organic growth faster than anyone anticipated.
And this is arguably the most critical piece of the entire earnings report.
Yeah.
Yeah, because VWR is their distribution arm. It is the front line of their business, meaning it's highly sensitive to real-time, day-to-day customer demand in labs.
Like research centers, manufacturing facilities, that sort of thing.
Exactly.
So let's share the hard numbers here. Q2 shows $241 million in revenue for VWR.
Which translates to a positive 1.7% organic growth rate.
Right, and they maintained profitability while doing it, pulling in an adjusted operating income of $126 million. That gives them a 10.2% margin.
And that 1.7% organic growth figure is really the pivot point here.
How so?
Well, when a distribution business of this scale finally flips from negative to positive growth, it tells you that the destocking phase we just talked about is actually clearing out.
Oh, like the warehouses that were stuffed with unused pipettes and filters and safety gear are finally emptying.
Exactly. Customers have burned through their pandemic-era safety stock.
Right.
and they're physically forced to start ordering everyday consumables again.
Okay, but I look at that 10.2% operating margin, and I think that's the real unsung hero of this segment.
Oh, absolutely.
Because if you're a distributor desperate to show revenue growth, the easiest trick in the book is to just slash your prices to move volume out the door.
Yep, heavy discounting.
Right. The fact that they maintained a double-digit margin proves they didn't rely on deep discounting to engineer that 1.7% growth. They actually held their pricing power.
Which really points to the underlying health of their customer base.
Yeah.
Labs are willing to pay standard pricing because their own research and production schedules are ramping back up.
Okay, but then we look at the other side of the house. Bioscience and medtech products, or BMP.
Yeah, a slightly different story here.
Yeah, the numbers here paint a much different, far less rosy picture at first glance. We're looking at $452 million in revenue.
Which is a 5.6% organic decline.
Right. Now, management was quick to note this was near the high end of their own internal expectations.
True.
And they did maintain a very strong adjusted operating margin of 26.0%, generating $118 million in adjusted operating income.
Right. The profitability is still there.
But I have to play the skeptic here for a minute. To a retail investor reviewing these financials, a 5.6% drop in a high-margin segment looks like a glaring red flag.
It definitely stands out.
Yeah, so can you explain why analysts are giving them a pass on a massive current quarter revenue drop like that? Why does a 1.1x book-to-bill ratio give them that confidence?
Well, it comes down to separating the leading indicators from the lagging indicators.
Yeah.
Revenue, by definition, is a lagging indicator. It only tells you what was physically shipped and billed over the last 90 days.
Right, it tells you where the company was, not where it is going.
Exactly. The forward-looking bright spots in this BMP segment are what analysts are actively modeling right now. For instance, their process chemicals division significantly overperformed expectations.
Okay.
But the real anchor for optimism is that double-digit order growth and that book-to-bill ratio of 1.1x that management reported.
I want to stop and examine that 1.1x book-to-bill ratio because I think a lot of retail investors might misunderstand how this metric functions in a manufacturing context.
Sure.
If I am taking in $110 in new orders for every $100 of product I am physically shipping out the door, doesn't that just mean my supply chain is broken and I am falling behind on deliveries?
In a fast-moving consumer goods business, yes, that would be a terrible sign.
Right, like Amazon falling behind on packages.
Exactly. But BMP isn't shipping two-day delivery items. They are producing highly complex bioprocessing chemicals.
Specialized excipients, medical-grade silicones.
Exactly. These are products that require long lead times, strict quality assurance, and rigorous regulatory compliance.
So it's not off-the-shelf stuff.
Not at all. Customers don't order these for tomorrow. They book them months in advance to secure their own manufacturing pipelines.
Oh, I see. So they aren't falling behind. They are actively building a backlog.
Mathematically, a ratio above 1.0 guarantees future revenue. They are filling the pipeline back up.
Okay, that makes sense.
That double-digit order growth hasn't translated into revenue yet, purely because the production and shipping cycles take time. But the demand is locked in.
So that is why analysts are completely comfortable looking past the 5.6% drop in current revenue.
Right. The lagging indicator is negative, but the leading indicator is flashing bright green.
That distinction between leading and lagging indicators is vital. But, top-line revenue and segment orders only matter if they eventually translate into actual tangible cash.
Oh, absolutely.
Because a massive backlog is totally useless if it costs you a fortune to fulfill it. Are they actually keeping any of this money, or is it getting eaten by operating costs?
Let's look at the margins.
Yeah, let's dive into margins, cash flow, and capital allocation, because this is where we see how effectively Avantor is actually running the machine.
Right.
So adjusted EBITDA came in at $254 million, which represents a 15.0% margin.
And this brings up a notorious friction point in earnings reports.
What's that?
The massive gap between GAAP metrics, the generally accepted accounting principles, and the non-GAAP or adjusted metrics that management prefers to highlight.
It is a colossal spread this quarter. I mean, GAAP net income was only $38.1 million.
Yeah.
But their adjusted net income was reported at $143.3 million. That is nearly a $105 million difference.
It's huge.
Whenever I see a spread that wide, my immediate instinct is to assume management is hiding operating failures behind the word adjusted.
And honestly, that skepticism is usually warranted.
Right.
But in this specific case, the bridge between those two numbers is largely driven by a single line item.
Just
$75.9 million in amortization.
Okay, break that down for us. Why are we comfortable ignoring an almost $76 million expense?
Because amortization of acquired intangible assets is a non-cash charge. It is an accounting artifact.
Meaning no money is actually leaving the bank account.
Exactly. When Avantor made massive historical acquisitions, they acquired a lot of intangible value, things like customer relationships, patents, brand equity.
I follow you.
Accounting rules forced them to slowly write down the value of those intangibles over time, which hits the GAAP net income as an expense.
Right.
But they aren't actually writing a $75.9 million check to anyone this quarter. When you strip that out, along with some specific one-time restructuring costs.
The $143.3 million adjusted figure gives you a much more accurate picture of the actual cash-generating power of the underlying operations.
Exactly.
Which naturally leads us to the free cash flow. They generated a robust $152 million in free cash flow for the quarter.
And it's worth noting that excludes about $9 million in cash restructuring costs.
Right. But the truly fascinating part of the story is their capital allocation strategy. They are hyper-focused on debt paydown.
Very aggressive on that front.
Yeah, they took that cash and repaid $112 million in debt in Q2 alone.
And if you zoom out, the scale of this debt reduction is incredibly aggressive. Since 2023, net debt has been reduced by $1.9 billion.
Wow.
That brought their adjusted net leverage down to 3.3x at the end of Q2.
On their way to a sub 3.0x goal, right?
Yep. Management is openly marching toward getting leverage below 3.0x. This relentless focus on the balance sheet is exactly why Moody's just revised their outlook on Avantor to positive.
It makes a lot of sense. Think of Avantor's cash flow strategy right now, like a homeowner who is aggressively trying to pay down a high-interest mortgage.
Okay, I like that analogy.
Right. So they generate $152 million in free cash. That's their take-home pay after the bills are settled. They immediately throw $112 million of it directly at the mortgage principal.
Right.
They aren't going out and buying a sports car, which in corporate terms would be executing a flashy new acquisition or funding a massive stock buyback.
Yeah, no flashy stuff.
Exactly. They are paying down the structural debt, but they are still holding back just enough cash to, say, renovate the kitchen.
Meaning they are continuing to invest in the business.
Right. Investing in their internal digital platforms and their supply chain.
And the reason that mortgage strategy works so well right now is the broader macroeconomic environment. We are living in a higher for longer interest rate regime.
Oh, yeah. Debt is expensive.
Exactly. In that world, carrying 4.0x leverage is a massive liability. By reducing that leverage down to 3.3x, they fundamentally de-risk the equity.
Right, because it structurally lowers their ongoing interest expense.
Yep. Every dollar they save on interest payments flows directly down to earnings per share in future quarters. It's a highly disciplined, defensive posture.
But it builds a fortified foundation for aggressive growth when the cycle finally turns.
Exactly.
But, all of this cash generation, order growth, and debt reduction didn't just manifest out of thin air. It is the direct result of a highly specific strategic overhaul by CEO Emmanuel Leiner.
The Revival Initiative.
Yes, the Revival Initiative. We need to look at the mechanics behind this, because he didn't just tweak the edges when he stepped in. He essentially rewired the entire company.
The sheer scope of this revival program is staggering. I mean, it started with a comprehensive top-to-bottom operating review the moment Leiner took the helm.
Right.
And what that review uncovered clearly necessitated a massive organizational shakeup.
You say massive, but the actual turnover is almost hard to comprehend.
Yeah.
They refreshed over 60% of their executive leadership team cumulatively over the past 12 months.
Yeah, cleaning house.
Totally. That includes bringing in absolute heavyweights. Mary Blenn as the new COO, Ludovic Brelier as EVP and Chief Technology Officer, and Jerry Porica as EVP of Quality and Regulatory.
Right.
I mean, that holiday party must have been incredibly awkward. Replacing over 60% of your executive team in a year is a massive disruption.
It is.
Is this a sign of a company that was fundamentally broken and operating in deep crisis mode? Or is this simply the required cost of executing a true corporate revival?
Well, it is likely a bit of both. You absolutely do not replace 60% of your executive leadership if operations are humming along perfectly.
Fair point.
The post-pandemic hangover ruthlessly exposed the inefficiencies in Avantor's operating model.
Yeah.
They realized they were too slow, too regional, and too siloed.
Right.
But the fact that they executed this level of executive turnover while simultaneously paying down $1.9 billion in debt and returning their primary distribution segment to growth.
It suggests this wasn't just a panic, chaotic purge.
Exactly. It was a calculated, deliberate upgrade.
They realized the old guard couldn't execute the new mandate.
Right. They needed operators who deeply understood lean supply chains, global digital integrations, and strict quality control, and they went out and hired them.
Which leads to the operational side of the revival initiative. Alongside the personnel changes, they initiated a deep optimization of their supply chain and inventory.
Yeah.
A key phrase management kept using was bringing the VWR business under one roof, while simultaneously relaunching VWR.com to accelerate their e-commerce capabilities.
Right, a digital investment.
So what does under one roof actually mean in a physical operational sense?
Before this initiative, VWR was operating more like a fractured set of regional distributors rather than a cohesive global entity.
Oh, interesting.
They had disparate IT systems, overlapping warehouse footprints, and isolated inventory pools.
That sounds like a logistical nightmare.
It was inefficient. So under one roof means physically collapsing redundant warehouses, putting everyone on a single global ERP system, and treating inventory as an integrated ecosystem.
Okay, so if a lab in Germany needs a specific bioscience product, the new integrated system can locate it globally and ship it efficiently, rather than relying solely on a regional warehouse that might be stocked out.
Exactly, which directly ties back to that 1.7% organic growth in VWR we discussed at the top of the show.
Sure.
Breaking down those silos is what allowed them to optimize their inventory, respond to customer demand faster than their peers, and actually capture that returning volume this quarter.
Okay, so having praised the mechanics of this turnaround, we have to critically examine the assumptions built into their projections.
Always.
Because the guidance bump is a great headline, but the assumptions underneath it are the actual roadmap, and we need to stress test them.
Right, because if any of these underlying assumptions crack, the full-year guidance will collapse.
Let's reiterate the upgraded outlook real quick. For the full year 2026, they expect organic revenue growth between negative 0.5% and positive 0.5%.
Yep.
Adjusted EPS of 80 to 83 cents, and adjusted EBITDA margin holding steady between 14.8% and 15.3%.
And a massive $500 million to $550 million in free cash flow.
Right. So let's look at the key assumptions propping those numbers up. First, the share count. They are assuming a fully diluted share count of 677 million shares.
And pointing out that static share count is crucial because it proves they aren't relying on financial engineering.
Right.
Sometimes a company will issue debt to buy back millions of shares, artificially inflating their earnings per share simply by reducing the denominator.
But Avantor isn't doing that.
No. The projected EPS growth has to come organically from operational efficiency and the lower interest expenses resulting from their debt paydown.
Then we have to look at the ongoing costs of this turnaround. The company incurred $24 million in restructuring, severance, and related impairment charges in Q2 alone.
Yeah, that's not cheap.
No, that tells us the revival initiative is still hitting the balance sheet hard.
Turnarounds are incredibly expensive before they become profitable. That $24 million is the literal cash cost of that 60% executive turnover we talked about.
The severance packages, the physical costs of shutting down redundant facilities.
Exactly. It is a painful cash drag right now, but it is entirely designed to structurally lower their operating expenses going into next year.
But here is the biggest assumption of all, and is the one that deserves real scrutiny.
Okay.
The upgraded revenue guidance assumes a 0.5% foreign exchange tailwind based on a blended euro to US dollar exchange rate of 1.15.
Right, the FX benefit.
Now, if you strip away that 0.5% mathematical FX tailwind, the absolute top end of their organic growth projection is entirely flat.
Yeah, code 0%.
Right. So should retail investors be tempering their expectations here, accepting that actual volume-driven real growth isn't returning until 2027?
Honestly, that is the most sober, accurate way to interpret this report. The turnaround is undeniably working, but it is currently a margin expansion and cash flow story.
It's not yet a high-growth volume story.
Right. The FX tailwind is a nice mathematical benefit for the reported revenue, but it masks the reality that underlying global volume in the life sciences sector is essentially just treading water right now.
They are just maximizing the profits on a flat volume of sales.
Exactly. Management has successfully stopped the bleeding. They cleared out the bloated inventory, they fixed the balance sheet, and they upgraded the leadership team.
Yeah.
They did everything within their control. But the broader life sciences end market hasn't fundamentally accelerated yet.
Right.
For real, undeniable organic growth driven by soaring customer demand, you are absolutely looking at 2027.
Which leaves us with a broader industry question to mull over. If Avantor's aggressive revival, marked by heavy debt reduction, massive executive turnover, and strict supply chain optimization, successfully bridged the post-pandemic hangover, perhaps retail investors should be looking for similar drastic restructuring signals in other underperforming life science tools companies as a leading indicator of a bottom. If management teams at other firms aren't making these painful structural changes right now, they might just be sitting on their hands, hoping the macro environment magically saves them. Avantor didn't wait.
That's a great point to watch for.
Make sure to follow the show to get this level of daily earnings coverage delivered straight to your feed.